Now, let's think about this a little bit, because the concept of contract manufacturer is, I think, a very important one to know generally, as well as for specifically this case. Let's say, Kristen, that you have particular knowledge about how to manufacture a product. You also have a patent that says that, you know, only you or your licensee, if you choose to license somebody, can manufacture that product. Now, that ability means that you're the only one in the world who can do this unless you license it. You know, you've got a patent. And it's recognized not only in the United States, but you've registered that patent right appropriately in other jurisdictions. Now, could you look at Ricardo over here and say, well, gee, you're not sure about him generally, but you know he's able to manufacture. He has certain manufacturing talents. Now, he might not have the specific know-how for your product. He might not have the right to manufacture it because he, of course, is not a licensee. But could you give him the specifications to your product, give him some help in how to do it, and using your rights, you arrange for him to manufacture for you? Could you do that? Yes, Peter.
It depends on the terms of the license agreement.
What license agreement?
Between the original licensor and licensee.
She owns the patent.
Oh, you own the patent.
Yeah, she hasn't licensed to anybody. She could, but she hasn't. Does she have to license to him the rights to be able to have him manufacture something according to her specifications? I see the non-lawyer back there going, no. Okay, I see a few other people as well. Yeah, she has the ability to arrange for somebody else to, you know, do the heavy lifting, so to speak. He doesn't have to have the right to do it because he's not going to earn something from selling that product, in a sense. It's all under her control. It's her rights, her patent rights, that allow her to do it and prevent others. But she can allow him to manufacture according to her specifications. Now, if her patents are very valuable, and she's going to take the products that he creates, and she's going to sell them to Ben over there, who's a distributor in another country and who's unrelated to her. What is the relative amount of profit that she will expect to earn versus the amount of profit over here that Ricardo is going to earn from the work he does? Is his work going to earn him profit that includes any component for that intellectual property, that patent? Yeah, no, it's not. He's just performing a service. Whether he's paid on an hourly rate, a piece rate, whatever it is, he's being paid for a service. He doesn't have any rights to the patents. He's being paid a service. So if those patents happen to be very valuable, all of that value stays with Kristen. Now, here we're talking about a situation where we have three unrelated parties. Kristen, I don't know whether you'd want to be related to Ricardo. That's a different issue. But anyway, factually you're not. And Ben, would you want to be related to him? Ben, I think you have just been insulted.
I'll be related to you, Ben.
We're sorry to hear that. But anyway, so the point is that this is reality as to what happens. 3 unrelated parties, and this is a very normal commercial relationship among 3 unrelated parties. Well, I keep over time, beating on the table about the fact that we have a blank sheet of paper, we can create whatever boxes we want, we can create whatever agreements between those boxes we want, and generally, tax authorities respect it, courts respect it, and it's especially strong when we do things in a good, normal manner that they would be commercially done in unrelated situations. So, yes, looking at this chart, we can have, let's see, I think just to say one thing I had not re-said, and that was that Wynn had sold in a sense, the exploitation, the rights to exploit the patents outside the United States to the Swiss company, to the Swiss member of the group. So we now have a Swiss company with intellectual property. We have an office in the Netherlands, which we have not yet put a box around. An office in the Netherlands where there are people who are going to be doing real functions. In other words, Kristen needs to control what Ricardo does. She needs to give him directions. She needs to give him guidance. She needs to make sure, from a quality control standpoint, that what he's doing is up to snuff. I mean, there are real functions that she's going to have to perform, either personally or through her employees, to make sure this happens. So these people, from the standpoint of the supply chain planning, these people are in the office in the Netherlands. So now, getting back to this analogy, we have an owner of technology in Switzerland. We have this group in the Netherlands that's going to perform various functions. We have the manufacturing being done in Malaysia, in this Malaysian company. We have the equivalent of Ben Santos over here doing a distribution function, let's say in that one being in China. Well, we can create within this group, again, whatever we want. So if we want to have that office in the Netherlands, let's now put a box around it and say that's going to be a Dutch company. Why a Dutch company? Well, gee, the Netherlands happens to have one of the finest networks of tax treaties in the world. So the Netherlands is a pretty good place. So let's make it a Dutch company. And that Dutch company, of course, does not have the rights to the technology. The Swiss company has it. Well, can we have a license between the Swiss company and the Dutch company? Can we? Well, yeah, we can do whatever we want. So let's have a license of the IP from the Swiss company to the Dutch company. So now the Dutch company has the right to manufacture this product because they have these rights under a license. So they, having these rights, just as Kristen did with Ricardo, that Dutch company can enter into contract manufacturing arrangements with unrelated parties and with related parties. So we have a contract manufacturing arrangement between the two. Now, just as we said that Ricardo has no right to any of the profits that really relate to the intellectual property, well, those contract manufacturers, whether related or unrelated, aren't going to have any rights either. So what sort of transfer pricing mechanism sort of works well with this kind of situation? Ben?
With which transaction?
With the between the Dutch company and the contract manufacturers.
It could be a cut. Sorry. Cusp.
Cusp?
Comparable service price, right?
Well, okay, yeah, you could, okay, very good. Yeah, you could have some sort of, yes, comparable service price in the sense of how much margin are they going to earn for performing the service. The more usual thing, which is what I was sort of expecting, was just the simple cost plus method, which very simply says, well, gee, what are your manufacturing costs? Add on a percentage for a profit element for that contract manufacturing, and we have a price. And of course, if this is, relatively speaking, somewhat basic manufacturing that is not using high-level technology, and the reason it's not is because between Ricardo and Kristen is the one that's providing it, so she doesn't have to pay him for what she owns. And the same thing here. The Dutch company is the one that has the right under the license from Switzerland to manufacture this. So the Dutch company is not going to pay either related or unrelated contract manufacturers for what the Dutch company already has a right to. So the amount of profit that the contract manufacturers will make will be limited to just the economic profit on the manufacturing function. Now, we can, of course, control a little bit as to whether that's a bit higher margin or whether that's a bit lower. Well, how do we do that? Well, there's various risks that we can choose as to which party will have that risk. So, for example, if our contract, or let's say, for example, that the Malaysian manufacturer has a capacity of 100,000 units per year. Well, if under that contract the Netherlands, the Dutch company, agrees to pay for 100,000 units, no matter whether it needs 100,000 units or not, then the Dutch company is taking the business risk on whether it can sell what it is contracting to buy. So that's a relatively major risk. And because the Dutch company is taking that risk, it means that the Malaysian company is not taking that risk. If I know that I'm going to be able to sell 100,000 units, well, that's a pretty sure thing. I'm willing to take a lower price. So placing that risk in the Dutch company's hands means we put downward pressure on how much profit is in Malaysia and increase the amount of potential profit which is in the Dutch company. I say potential because, well, gee, maybe the customers won't be there. Maybe the Dutch company will end up with worthless inventory that it has to abandon. Well, that's risk. But with taking that risk, it also means relative to other members of the group, it will have higher profitability, assuming that business goes well as opposed to badly. Looking over between the Dutch company, let's say, and the Chinese distributor, we have the same issue. We know we're going to sell the product. In other words, the Dutch company will indirectly, through the contract manufacturers, manufacture the product and now sell around the world. In one place it's selling is into China. And we know that ultimately China, the Chinese company, will be selling as a, will buy and resell to Chinese customers. And between the Dutch company and the Chinese company, we of course need to set a price. Now, do we set that price relatively high? Do we set it relatively low? What's our objective? Well, let's assume for the moment that the effective tax rate on these transactions in the Netherlands is the effective tax rate is lower than the tax rate in China. Let's assume that. And let's assume that therefore we want to push, if we can, more profit into the Dutch company than into the Chinese company. Okay? So we, again, we say what's our overall goals? It's, to avoid subpart F in terms of having the maximum amount of deferral, and secondly, reduce foreign taxes. So we want to the extent we can, put the least profit into that Chinese company. Well, on the basis that we are, that Win is a socially responsible company that's going to properly obey the law in all the countries in which it operates. And of course, you wouldn't want to work for a client that wanted to do something different, but that's another issue. How do we legally reduce the amount of income that is going to be in China and maximize what's in the Dutch company? Well, if we have a distribution agreement that's going to set the pricing, we need to look at the terms of that distribution agreement. And because, of course, we're writing it, so we have total control on what goes in that agreement, we want to write that agreement to achieve that objective of maximizing the price to the Chinese company, thereby reducing the profit level in the Chinese company and maximizing the profit in the Dutch company. So what are a few of the items that we can put in that agreement, that distribution agreement, to achieve that goal? So, Ben?
Well, you make them low-risk distributors, like they're not responsible for maybe advertising, marketing costs, or yeah. Okay, that's a perfect first thing to mention. We'll try to mention one or two more things. But yeah, you mentioned marketing costs and advertising costs. Now, marketing cost is sort of nebulous as to exactly what it is. So let's focus on advertising, which is maybe more understandable to us. Because we're inundated every day with advertising, and hopefully all of you will know what it is. So if the Dutch company is going to bear the cost of all advertising, and as a result of this, the China company will not have any advertising expense, what does that do? How does that affect pricing? Why should that affect pricing? What do you think, Ben?
Well, if China doesn't carry that risk, then the Dutch could potentially charge more for, like you were saying, products, because in that cost is the expense for doing the marketing in China for them.
Yeah, that's exactly right. Let me say it a little bit differently to try to get to, in a sense, the economics of it. If the Dutch company pays for the advertising, the Dutch company is taking a risk. Why do I say they're taking a risk? Well, maybe it'll be bad advertising that won't generate any sales. Maybe it'll be good advertising which generates a ton of sales. We don't know. And before they conduct the advertising, they don't know whether it'll be a successful advertising campaign or not. That's taking risk. And if, in fact, let's say, for example, that because the Dutch company bears the advertising cost, we're able to have a $1 higher price on the product. So let's say the advertising cost is 100. The actual advertising cost is 100. And if, as a result of the advertising, there's, again, let's first say it's bad advertising, and there's only 50 extra sales as a result of the advertising. Well, that means that the Dutch company expended 100, but only got additional revenue of 50. 50 extra sales times the $1 higher price. On the other hand, if the advertising campaign is very successful and they end up with 200 sales instead of only 50, then there's additional revenue of 200. So the variability on income is solely within the Dutch company. The Dutch company expends the money. The price of the product to the distributor is a fixed amount, and there will either be enough sales to get that back plus some profit, or maybe not enough sales to even recover the cost. So the risk and the benefit is in the same place. It's in the Dutch company. Ben used a term, limited risk distributor. So one aspect is advertising. What about credit risk if you have a deadbeat customer? Now, under, let's say, most normal situations, the distributor itself is going to take the risk of a deadbeat customer. But there's nothing wrong with choosing through terms of the distribution agreement for that risk to be in the Dutch company and not at the distributor level. It's totally controllable, and because of that risk, again, you're able to charge a marginally higher amount by the Dutch company to the Chinese company. What about the risk of obsolete inventory? Again, same thing. You can contractually put that risk inside the Dutch company. And again, maximize the price being charged to the Chinese company. So in this way, again, looking from an overall perspective, in this way, we are putting the bulk of the profits in the Dutch company, and we are avoiding, as much as possible, income within the location of manufacture and the location where the sale is being made. Yes?
From the Chinese tax authorities' point of view, is this all kosher?
Very, very good question. We're talking, we have studied Section 482, and we've seen these, miserable rules. What about other countries? Well, other countries generally do have their own transfer pricing rules. And most of those countries follow the OECD model in terms of the methods available and when they should be used. There are some differences between the US and the OECD. Now, to get to your question, yes, essentially under the OECD rules, which is roughly what China is following, they will use the same approach as pretty much every other country. Now, are there very many within the Chinese tax authorities that understand transfer pricing? At this point in time, not so many, but that will grow over time. But everybody's working with roughly the same set of rules on coming up with a supportable transfer price that reflects both reasonable, economics, and which reflects the contractual relationships which are generally respected between related parties. Yes, Jessica?
With all these contracts and all the intricacies of transfer pricing, if you get audited for this, how long does the typical audit of one of these take?
You measure it generally in years. For example, first there's the audit process domestically in whatever country is doing the audit, whether it's the Chinese authorities, whether it's the US authorities. Then at some point, maybe you go to competent authority if there's a treaty between the two countries, and that process can take another year or two. So this is a very long and involved process, and it starts to make sense as to why you've got that 10-year statute of limitations for foreign tax credit purposes. So yeah, good question. Okay, so we have been maximizing profit within the Dutch company, and we've done it by taking, again, activities and risks and isolating them within the different boxes which we create, the different companies which we create. Now, in actuality, China has a 25% rate. The Netherlands have, if I remember correctly, I think a 25.5% rate. Malaysia has a 25% rate. Well, gee, are we just, playing with ourselves, so to speak? Is this, does this achieve anything? Well, remember, Switzerland is where the IP is. And we haven't spoken yet about what terms there might be for a royalty between Switzerland and the Netherlands. So to the extent that we can have, relatively speaking, a somewhat higher, higher royalty going from the Netherlands to Switzerland, where, oh gee, there's there's an ability to have a relatively low tax rate of maybe 5 or 10% in Switzerland. To the extent using the royalty, we pull earnings out of the Dutch company and put them into the Swiss company, we're now achieving this, let's say, relatively speaking, lower level of foreign tax. Now, we haven't talked about the subpart F part yet, but looking at the foreign tax, we are, on a worldwide basis, ignoring the U.S. for a moment, on a worldwide basis, we are reducing the level of foreign tax. We're minimizing how much is in Malaysia to just the economically necessary amount for just the strict manufacturing function. No business risk, no risk of obsolete inventory, no risk regarding whether they're going to have enough sales to keep their employees, for the whole year, to pay them their salaries and so on. And similarly on the distribution side, minimizing the risk there to maximize what's in the Netherlands, and then moving a lot of that out through the royalty. And of course, the royalty, because this is such valuable technology, the royalty can be relatively high and presumably quite supportable. So we end up with a relatively low taxability.